According to Vanguard research cited by the Motley Fool, RMD penalties cost Americans $1.7 billion annually. In 2024 alone, 7% of Vanguard IRA holders missed their required minimum distribution, averaging over $1,100 in penalties per person. Not because they were irresponsible, because the rules are genuinely complicated and nobody walked them through it. Your 401k or IRA has been accumulating quietly for decades. You've contributed, it's grown, and you've largely left it alone. The moment you retire, and certainly by the time you reach age 73, the rules change significantly, and the government is paying attention. Today, we're walking through exactly what happens to your retirement accounts when you retire. The withdrawal rules, the tax implications, the mandatory distribution requirements, and the decisions you need to make before they're made for you. Let's start with the basics. Your 401k and traditional IRA are tax-deferred accounts. You got a tax break when the money went in, and the investments have grown without being taxed along the way. The trade-off is that you will pay taxes when the money comes out. That's not a penalty. It's the original agreement. When you retire, you can begin taking distributions from these accounts without the 10% early withdrawal penalty. As long as you're 59 and a half or older, you can take as much or as little as you want. The withdrawals are added to your taxable income for the year, which means smart withdrawal planning, spreading withdrawals across years to manage your tax bracket, can save a meaningful amount over a long retirement. But here's the part most people don't think about until it arrives. Required minimum distributions. According to the IRS, if you have a traditional 401k, traditional IRA, or most other tax-deferred retirement accounts, you are required by law to begin withdrawing a minimum amount each year, starting at age 73. The government has been deferring taxes on that money for decades, and at 73, it begins collecting. Your first RMD must be taken by April 1st of the year after you turn 73. Every subsequent RMD must be taken by December 31st of each year. If you wait until April 1st for your first one, you'll have 2 RMDs in that calendar year, which can push you into a higher tax bracket. Many financial planners recommend taking your first RMD in the calendar year you turn 73 to avoid that bunching. The IRS calculates your RMD by dividing your account balance as of December 31st of the previous year by a life expectancy factor from their tables. The factor decreases as you age, which means the percentage you're required to withdraw increases over time. Your brokerage or plan administrator will typically calculate this for you, but you are ultimately responsible for getting it right. What happens if you miss an RMD or don't take enough? According to the IRS, the penalty is 25% of the amount you should have withdrawn. If you were required to take $10,000 and didn't, you owe $2,500 to the IRS on top of whatever income tax would have been due. That penalty can be reduced to 10% if you correct the error within 2 years. But it's far better not to make it in the first place. According to CNBC, one of the most common RMD mistakes is forgetting about old accounts. If you have a 401k from a job you held 15 years ago, a rollover IRA from the 1990s, or an inherited IRA from a parent, those accounts all have separate RMD requirements. They don't consolidate automatically. Missing any one of them triggers the penalty. A few important exceptions worth knowing. Roth IRAs are not subject to RMDs during your lifetime. The money in a Roth IRA can stay invested and grow tax-free until you choose to withdraw it. This makes Roth accounts particularly valuable in later retirement planning. Roth 401ks, as of 2024, also are no longer subject to RMDs during the owner's lifetime, thanks to changes in the law. If you are still working at 73 and have a 401k through your current employer, and you own less than 5% of the company, You can delay RMDs from that specific account until you retire. This exception does not apply to IRAs or old employer accounts, only your current employer's plan. One strategy worth knowing: Qualified Charitable Distributions, or QCDs. If you are 70 and a half or older and want to give to charity, you can donate directly from your IRA to a qualified nonprofit. Up to $108,000 per person in 2025. This donation counts toward your RMD for the year, but doesn't show up as taxable income. For people who donate regularly, this is one of the most tax-efficient strategies available, and is, according to CNBC, significantly underused.